Good morning, everyone. Here's your market update for today. So, starting with the US dollar index, the US dollar strengthened at the start of the week as traders positioned ahead of a heavy schedule of the delayed US economic data following the government shutdown. The key focus will be Thursday non-farm payrolls report, which should give a clearer insight into the labor market conditions. So short-term funding dynamics also supported the dollar. A tightness in the repo market and a rise in the effective federal fund rate have lifted the short-term dollar yields. And the SOFR rate remains above the excess reserve rate, drawing liquidity into the repo market and adding pressure on the Fed funds market. That is a condition usually supported the dollar in the near term. And technically, the index continues to consolidate between 98.62 and last week high of 99.74. The RSI at 56 suggests clearer direction emerging. A minor double bottom around 98.98 and 99 offers a near-term support, while resistance remain at 99.74 and the psychological 100 level. So moving to WTI crude oil. The oil is trading near $60 and $60.60 after rebounding from last week losses. The restart of operations at Russia seaport eased immediate supply fears, but broader geopolitical risk remains elevated. Ukraine's continued attacks on Russian energy as asset, along with Iran's seizure of a tanker in the Gulf of Oman, are keeping the market on edge. And additional uncertainty comes from upcoming US sanction on Luke Oil and Rosneft. And positioning data shows traders increasing net long position largely through short covering, reflecting hesitancy to stay bearish in such a volatile geopolitical environment. And technically, WTI remains weak and range bound beneath the major moving average. RSI sits near 52 and momentum indicators remain flat. Key support is last week's low at 58.12. Resistance stands at the $60 psychological level and the 65-day moving average near 62.38 zone. Next, talking about spot gold. The gold opened the week with a sharp drop, falling near 2% to a low of $4,006 before stabilizing about 40.45. The decline followed the Fed's continued pushback against expectations of a December rate cut, which triggered a rebound in the US dollar and weighed on gold demand. Although Treasury yields eased slightly, the funds have recently returned to US government bonds as their preferred safe haven, reducing gold's defensive appeal. With the key $4,000 level under pressure, strong NFP numbers or hawkish Fed minutes could push gold towards the 3,900 and 3,950 support zone. Medium-term sentiment, however, remains generally constructive. And technically, the chart has returned slightly bearish. The 4,000 to 4050s region is now a critical battleground and may signal a temporary top. A break below 4,000 opens the way to 3,954 and then 3,900. And resistance sits at 4070, 4,100, and Monday's high at 4,108. Last but not least, the Australian dollar. The Aussie dollar briefly dipped to 64.65 before rebounding above 65 cents, following cautious comments from the RBA. Minutes from the latest meeting reinforced the RBA's data-dependent stance, with inflation, strong demand, and housing momentum limiting the case for easing. And recent labor market strength has also reduced expectations of early rate cuts, with markets pricing only 40% chance by next May. And Australian dollar remains in a narrow consolidation range. The pair is trading below the 10-day moving average at 65.14, while RSI near 40 points to weakening momentum. Key support lies at 64.57 and 64.14, while resistance is at 65.14 and also 65.55. So that concludes today's morning review. We will continue monitoring US economic data release, geopolitical developments, and also central bank commentary as the week unfolds. So have a great trading day.